Hello and welcome. My name is Vicky Washay and welcome to A Wealthy Life. If you're watching on YouTube, you'll see with me that I have a guest. Her name is Elizabeth Pearson, and I will introduce you to her in just a minute. This is a little mini series of podcasts, if you like, which is really focusing on wealth planning, different ways of making your money, your resources work harder, because I love that sort of stuff. And Elizabeth has been investing in shares, which is different from me investing in property, and she's been doing it easily since 2006, but now she teaches us as well. So I thought, okay, we've got an expert in something that is just not something that I have found that my gears have they've like been jarring on this. They haven't quite got into a nice rhythm where I go, aha, that makes sense to me. So met Elizabeth and we've been having a chat, and she could well end up as like one of my new besties. And I just loved the way she spoke to me. So I thought, let's introduce her. So I've bigged her up big styley. Elizabeth, welcome to A Wealthy Life.
Thank you very much, Vicky. Thank you so much for having me on your podcast. It's a delight to be here.
Totally my pleasure. So look, I'm going to hammer you on this first question.
Okay.
Why is this important? So we're sort of thinking about really simple steps for women to invest in their financial future. So before we get into the shares bit, why do you think that it's so important for women to be planning for their financial future, their financial security?
Well, investing in anything, investing in property or stocks and shares or lots of things is important because, like, as you know, it's all about creating assets. So there are these things that work for us that create money for us independently of our jobs. Generally, because the work that we do, not always, is it doesn't necessarily pay us what we want, and it takes a lot of time. And the idea about investing in the stock market, like property, is it's giving you money independently of that. Um, and it's really important for women because there are just these big gaps. We've heard about the earnings gap, the savings gap, and there's a huge investment gap between what women and men have invested in the stock market for their financial future. And so that really, it matters, because what that means in the future is that women don't have the choices, the freedom, that we should have as our male counterparts. So that's why it's important.
Yeah, I completely agree with you. And I really want to be talking about this over the next, few podcasts here, because you talk about the gaps. I also think there are actually gaps in our earning ability. So nature has made it that we're the ones that carry the children. We're often the ones that take care of the children. There's a huge gap there in terms of your earning potential. You sort of tend to move back onto maternity leave. And even if you don't have children, then there can be the relationship gap where you've been in a relationship and you've created this financial life together and you've bought the house and everything else. And then that ends for whatever reason. And then there's this other gap where you've got to start again. And it's much more clunky, I think, for a woman. There's something about a man's ability, and if you're listening and you're a man and you're going, well, hold on a second, I have to work hard. No, absolutely, you work hard. And go back to that very first podcast I ever made, and we're well over the hundreds now. Over 100 podcasts ago, I said that men have this mentality about being so focused on generating the income, and they put a lot of effort into it, and I totally acknowledge that. But a woman's journey is somehow this clunky roller coaster ride that if you can level that out by having investments, why wouldn't you do that? It just makes sense. And I suppose one of the reasons you wouldn't, as you said, is because if you've got less money in the first place, then how do you get into it? Which is why I loved the conversation that we had before this that led to us having this conversation. So maybe do a little bit about how did you get into investing, and then we'll move into how can other people get into investing. So how did you start? Because you've been doing it for years.
Well, I didn't start by the normal route. So I'm not from a financial background. I actually used to be an architect. I still am actually. And I started to learn to invest from my dad. So my dad was a university academic and he taught himself to invest because he was very unhappy with some financial advice that he'd received. And it turned out he was very good at it, even though he's actually a very cautious, risk-averse person. So my thing was actually, I suppose actually it was to do with love, but I just thought, okay, how can I improve my relationship with my dad? Like, give us something more to talk about because, and I realized this afterwards, money is something, particularly in the UK, we just don't talk about. It's like a big taboo. It's just not British. So anyway, here it was. My dad, I could learn investing from my dad. I thought this would be good for us, dad daughter thing. And at the same time, I had an inkling. I thought, okay, this might be good for my financial future. And on both levels, it's absolutely worked. So, I saved up my money in my ISAs, and then in my lunch hour, in my job, I bought my first investment. This is 2006, and I was terrified. I thought I was going to die. Anyway, I didn't die, and hooray, here I am. And I found that because actually I was so busy being an architect and doing my life and thing, I don't know what it was. I just wasn't that interested in them really. So I just left them alone to grow. And that was absolutely the best thing to do. Um, so then, things moved on. I had various different jobs. And then I started teaching in between jobs. Some friends, I was kind of having to reinvent myself because my job had come to an end about investing. And I had a few friends found as my little guinea pigs, and they really liked it. And then it sort of took off from there. So that's why I do what I do today. And then as I went along, used to go to these investor shows with my dad, and I would just be in the absolute minority as a woman. And then as I read more about it, I just found that there was this big, as you were talking about, this gap, which is not to do with the fact that women aren't good at investing. They are very good. It's just all these things that get in the way. So that's where I am. So it's really about financial education, female financial education, and then it's also useful, for men too. Um, and then if that habit, and then using that money consciously, I suppose. So making it simple for people, making it sustainable in terms of how they can start and the amount of time, but also using it consciously, I suppose. Where is this money going? What is it supporting, particularly with what's going on with the planet? And just injecting a bit of sparkle into the whole thing.
Yeah, yeah. Oh, definitely. I think it's really interesting, isn't it? Because the word, when you were talking about, it's not that women aren't clever enough to do this, was I wonder whether it's a values thing, whether they recognize that actually planning for their future is important. And I know in my journey, I poodled along quite happily until I think I was in my late 20s, something like that, when all of a sudden with two children aged 1 and 3, my marriage broke down, and we were just pounded with financial crisis after financial crisis. While we were married, our uh, my ex-husband's business went bankrupt. Then we lost our house. It was repossessed. I'm a property investor. I have been repossessed. So my marital home was repossessed. We ended up in rental accommodation, and then he didn't pay the rent on that. And then we got kicked out of that. And then we ended up on benefits. And it's so easy to spiral down. And while you're in the downward spiral, you're like hanging on with your fingernails and then getting ripped off, sort of thing, trying to stop this slow, or this downward trajectory that you're on, and try and slow it so that you can stop it and then start to move back up again. And I just thought, this is it. Never again will I put myself in the position where I'm vulnerable like this. And I think it also came for me because I had the children, to go, if I am responsible for them, I need to have money to do that. And then the other thing you picked up about was, once you've done this and you've taken the idea of money and you've elevated it to a position where it becomes important to you, not money is important, but the financial security that you can get from money, and recognizing, I don't know what the opposite of a value is, but what I don't want is not to have the financial security. That's also important to me. is this idea of conscious spending. And I did a podcast of that again back in one of the early 6 or 7, something like that. I had a whole podcast around conscious spending. And it when you get how important financial security is, then actually it's then just a case of, oh, okay, so how can I do it? And once you're then doing it, it's like, well, why would you never do it? Why aren't all women doing this? It's, you just want to be able to shout it from the rooftops, really, don't you?
Yeah, I think well, there's lots of, I mean, there are lots of reasons, barriers, I suppose, to people and women starting. And I think there's, yeah, we earn less. And then there's also that fear. There's always that fear with investing. People's biggest fear is that they're going to lose everything,
Yeah.
which is quite understandable because there's so many tales, doom-laden tales of people who invest in a not very sensible way, losing everything. But there are things that you can put in place, which means that you don't have to worry about that. Things for your financial safety and security before you start investing. Um, the other thing, though, is it's just there's always been a bias against women to do with investing. I mean, I've just written this blog at the moment that's all about famous female investors, and the thing was, it was always whether you could invest or not as a woman was always defined by your marital status. So if you were married, basically you couldn't do it. If you were single or widowed, you had much more access to financial engagement. Um, and but then and even now, I mean, there was a study done by Starling Bank not that long ago where they were just looking at the imagery from women and men, the difference. And for men, to money and investing, it's there's images of them with sort of fast cars and wads of cash. Women, it's like we're told that we're not good with money. It's all about avoiding splurging money on shoes, and pictures of piggy banks. So it's piggy banks with pennies going in. It's just, even that scale of the currency that's used is different. So if there aren't, I only started to learn to invest because I had this person that I trusted, my dad. I mean, if I never would have come across it without it. So it's just like moving in those circles. It's just it's happenstance. So
I know,
yeah.
it's shocking, isn't it, really? And yet one of the other things I think is that it's just about maths. Money is maths, right? And it's the same thing with health and everything else. If you're fat, it's because too much is going in and not enough is coming out, or you're eating more calories than you're expending. The same thing with money. If you're in debt, it's because there's not enough money coming in, and more than you've got coming in is going out, and therefore you have that. So it's a sum. And it's those sums that we learned at school, x plus y equals z, or x minus y equals z. And you sort of like wondered, why would I ever know those? But it's that concept of it. But something is missing. How, it's almost like I want to know, is it just because you mentioned the imagery? Is it just because of imagery that men think that they can invest? Or is there something that men are hearing or talking? How are they learning and we're not learning? Is it just the imagery, do you think?
I think it's, well, I mean, I think it's lots of different things. It's the historical context of finance investing. It's the industry, which it's the products which are designed generally for men. I mean, it is changing for men, by men. It's a language. The language is very excluding. It's full of very unhelpful jargon, which just bamboozles people. It's having less money to start with. Also, there are certain, I don't know, myths about investing. So I think because women have less to invest and they are more cautious or risk aware, then we think that we need more to invest. So women think in the UK that you need at least £4,000 to start investing, which is not true. You can start investing very simply for as little as £1, to give it a go. And then the other thing, I think, because there is all that fear about it, is that women burden themselves by thinking we've got to know everything. And actually, you don't need to know everything. You don't need to be from a financial background. You don't even have to be good at numbers, which is another thing. You know, lots of my clients say, I'm not any good with numbers. That's okay. I mean, I have one client, she doesn't like spreadsheets. Fine. So she's drawing, things with colored paper and all that kind of stuff. So, there's always a way around it, but it's just lots of different levels which get in the way.
So that's quite interesting, isn't it? Talking about the language. And then I thought, oh, you know what we've done? We've started off, because the two of us have already spoken. We're talking about investing in shares, but there is also trading shares. And so maybe let's just debunk a bit of
good
the
idea.
myths. Do some jargon for us and break it all.
Okay. So yeah, it's an easy confusion to make. And people often think when I say investing that I sit at home on my computer and I've got like 3 screens with all these things going up and down, and I've got to log on at like 7 o'clock Pacific time and spend 3 hours. Nothing is further from the truth. So that is trading. So in trading, what you're doing is you're buying and selling stocks and shares on a sort of daily or hourly basis. Investing, so you're buying or selling to make a profit. With investing, you're buying and holding things. So you're buying and holding shares or funds, which are these like collections of shares for the long term. And what you want to do is you want to harness this magical force called compounding, where the money that you make makes more money and then makes more money, and to be paid dividends for the long term. So this is a 5 or 10 year thing. It's not quick fix. It's not trading. And trading is, people do it. I'm not interested in trading, partly because of the time needed. And you really have to know what you're doing. I mean, I read something recently. You have to have, in a way, the equivalent of an A level's worth of knowledge to do it. And what I've seen for people who do it is it's very emotional. So people make money in a day and they're all happy, and then they lose money, and then their emotions are low. So investing is slow, it's steady, it's boring. The best thing you can do as an investor is to be consistent, be disciplined, ignore the doom-laden news, and what else? I think that's enough to be going on with.
Yeah, no, that's really interesting, isn't it? Because when I've said, I'm not interested in shares, what I'm not interested in is that description with the I've got to have 3 monitors and I got to get up at 7 o'clock in the morning to like be in sync with America. No, I just can't be doing.
You can't.
I don't want to be ruled by anything other than if it's my rule and I think it's a good rule, then I'll follow that rule. But as for the rest of it, I don't want it. And there's so many parallels. I'm almost embarrassed. There are so many parallels between investing in property and investing in shares, as in consistent, do it for the long term, blah blah. Why have I not done it before? I'm just going, why did I not do this before? Well, obviously because I've never met you before, but why did I not do this before? And so, okay, so we've sort of tackled, the history and almost this sort of gender inequality thing with education, values, mindset towards it. So let's just get over all of that. If you're listening, whether you're a man or a woman, actually you could invest in some shares. And then I go, well, hold on a second. So we've done the jargon, we know the difference. And then I'm thinking, I've had shares before. I think I've had some shares in an ISA before. Isn't that what happens to our money in an ISA? So why wouldn't we just stick our money in the ISA then?
So what you're describing, there's kind of 2 places in the UK you can invest your money, which are really tax efficient. So you can have an ISA, a stocks and shares ISA, which is an individual savings account, or you can have a pension. You can have a pension, workplace pension, or you can have a SIP, which is a self-invested personal pension. So what you do is you put your money in there. So they're like bank accounts, but for investing. And then you can buy stocks and shares or funds with them. So funds are a really good way to start investing. What they're doing is, so you pay your money into this thing called a fund, and then it's used. There'll be a company that manages the fund, and what they'll do is they'll buy a lot, maybe 100 or 200, maybe more than that, different stocks and shares within the fund. And the reason that is good is because you have this thing called diversification. So if one company explodes or whatever, then you've got your money in all these different other things. So that's a really good way to kind of start investing. And there are sort of different places where you can invest. So a very simple way to start investing is to use something called like a robo advisor. They're digital apps. Some of them you can start with as little as £1. They give you like 3 or 4 different ways of investing, so it's simple. Or you can use something called an online broker, and they give you like more options, you get more choices. So that's if you want to spend a bit more kind of time doing it. But the idea with investing is you set yourself up. This is what I teach people: set yourself up, and then you just leave it alone to grow. You just leave it alone. But there are certain things which you don't want to be investing. You never want to invest money that you can't afford to lose. So you teach this with property as well. But you want to have, like I always say to people, have £1,000 in a cash savings account somewhere, which is for like expected, unexpected events, like the cat has to go to the vet or the dishwasher blows up. Then you need between 3 to 9 months of your sort of basic survival income also in a savings account. So, if you lose your job or there's a pandemic or, you've got something covered, then the idea is to take 10% of your net income and then put that towards your financial future. And that is about paying yourself first, creating assets and money that is going to work for you. So that's how.
So if I wanted to invest in shares,
Yeah.
I need to cough. Sorry.
Okay.
Sorry, Harlem. So if I wanted to invest in shares, have I got to have a SIP, a pension, or an ISA before I start? It's not it like, so if I wanted to invest in property, yes,
Yeah.
there's tax advice that would say it might be more tax efficient for you to invest in a limited company. But I could actually go and I'll see that house over there and I can do the maths and I can go, well, I think that house is going to pay enough rent that it's going to cover all the costs. That would be a good investment. I've done my homework and due diligence on that thing, and I could just go buy that house. And
Yeah.
of course I can use a mortgage. But I don't really have to have a vehicle or a thing. Do you have to have an ISA or a pension or a SIP? Because a share isn't like in the old days when you see like TV programs, you actually get a share certificate. You used to get a piece, like you've got your company, I'm going to come along, I'm going to invest in your company called Pearson Inc. And you've invented a didgeridoo thingamy, and here's my money, and you give me a certificate, and I literally own a piece of paper that says I own a piece of your company. Whereas now it's all this digital, it's all stock market, that none of it's real. So how do I have to have something to put my non-existent share certificate in then?
Yeah, you have to have a place to invest. So you can, so you have to go to an online broker or a robo advisor and open an account. So it could be tax efficient, buy an ISA or SIP, but you could just open a general like investing account or trading account. So I mean, all these things, they're like bank accounts except for stocks and shares. So you can buy and sell things within that. So that's the kind of place you can do it. I mean, in the olden days, you would have to ring up your stockbroker in the city and you'd have to have a lot of money and you would place your order with whatever it was. And so, yeah, thankfully, I mean, the internet has been fantastic for just democratizing access to the stock market for individual, ordinary people to do it. But yeah, you do need a
place that you're going to put it.
An investing account or a trading account, but the smartest thing to do is have an ISA or SIP, because then that is really tax efficient. You don't pay. You don't. Yeah, I won't go. Anyway,
yes.
It's not good.
Yes. So an ISA is going to make it much more grassroots level. It's easy. You can open up an ISA. A SIP, because it's in a pension, then you've got to have trustees, and it does need, there'll be more.
Not trustees, no. The thing with a SIP is that you can't take them, once you put the money in, if it's a SIP, you can't take the money out until you're 55. That'll go up to 57 in April 2028. If you have that's it. There's limitations as to when you take the money out, and then you do have to pay. You can take 25% out tax free when you get to that age, and then the rest is taxed as pay as you earn. But when you put the money into a SIP, you get your tax back on it. So say you're a 20% taxpayer and you put in like £100, the money, it's like magic, appears. You get like £20. So that's great. With an ISA, your money that you put in is in effect already taxed. But once the money is in there, whatever you make, you don't have to pay any tax on it. So every time I do my tax return, it's sort of unbelievable. You don't have to put your SIP or your ISA on your. You don't have to fill out a tax return for it. You do, if it's in a trading account or an investing account, you do have to sometimes put information on. So
Okay.
that's why it's also good. So we're very lucky in the UK. People don't realise, it's not the same in Ireland. It's not the same. We have these very fantastic tax efficient ways of investing.
Oh, that's cool. So, I mean, it's actually, I'm getting to the stage now where I'm going, and this is why we're having this conversation, because you piqued my interest when we were speaking before. It was okay. So I could open, simply, I could open an ISA because it's tax efficient.
Mm.
And then I could put some money in there, and then I could go shopping for shares.
Exactly.
Am I going to
All
have to
funds,
read
all
the
funds,
or funds?
all funds.
Yes. But am I going to have to go and read the company accounts and know that they made a profit in blah, blah year, and then less profit, and then they're going to make more profit, and they're predicted to launch a new product?
I could,
I've gone to sleep already.
yes, I know, and die of boredom in the process.
Yeah.
No, you don't. So
Okay.
this is what I'm saying. If you're starting off investing, the best thing to do is to buy these things called funds. So, and what they're doing, they're collections of they're collections of stocks and shares in one particular wrapper. And so that it means you don't have to be reading individual stocks and shares reports and things like that, which most people don't want to do. And there are many kind of there's quite a lot of research that says that actually that's the best and the simplest way to invest. So you can buy these funds, and what they do is they sort of follow what the stock market does. So you can buy a fund, something like it's like a global tracker, a tracker fund. And in that fund might be about, I don't know, like 2,000 or I don't know, a large number of shares in different stock markets all across the UK, not the UK, across the world. So as the stock market, goes up and down as a whole, your fund will just follow what that does. So when it goes up, it'll go up. When it goes down, but what you're doing is you've bought into, you like own these companies that in the long term are, the economy in the long term is going in an upward
Going
direction.
to
You
okay.
follow that, yeah. But
So
what you
it's a
can
bit like with the properties at the moment. You have no influence over the value of a property. The
yeah,
value of a property is supply and demand and what's going on in the economy. So the supply and demand is almost like the customer. So going back to the pandemic, if ever you get a time machine, go back and buy Zoom shares. That's the thing, isn't it? I mean, we're on Zoom at the moment. So
yeah,
before that, there was just this thing. If we had known that Zoom was going to be so big, we could have invested in the shares. So that's a bit like supply and demand changed Zoom's value because more people started using it, more people started buying it, so it increased in value. So you can have that with a house. So all of a sudden, there aren't enough houses for people to rent. More people want to rent the one house that's there, so the rental value goes up. So that's your supply and demand side. But then you also have generally the economy. So generally the economy says everybody's got a lot more disposable income, and therefore when someone puts their house for sale on the market, they ask another 5,000 for it, and someone just pays it. So then the next person in the street puts 7,500 on it, and then they pay it, and so then the value of the houses go up. So that's like the value of the company going up because, or the value of the whole stock market going up and down because, so you've got the whole stock market goes up and down, but you can also have the companies are going up and down on
yeah.
their performance.
Yeah, so you can, as a beginner investor, and lots of people are invested in funds, so these collective investments. Now, what you can do, so this is what I learned from my dad, and is sort of my speciality. You can invest in individual stocks and shares. So what I do is I have a portfolio of 20 shares or 25 shares. Now, to do that, it's using it's like using hard financial facts to choose those stocks and shares. And there are kind of resources that you can use to have those, that you don't need to read lots of reports. And what's still really important, though, is to have like a plan, a strategy of doing that. So, as I was saying, investing in general is about being consistent, about being boring. Most people, when they invest, particularly in stocks and shares, are random and whimsical. So the thing is, if you
Yeah.
can, and this is really difficult, is to invest without any feelings. Now, of course, with money, that's very hard because, and I've seen this myself, the value of my shares go down. I'm like, "Ooh," and then they go up. And then it's like, I'm happier. But we feel as human beings, we feel worse when things go down. We just, it's called behavioral economics. Yes. Okay. So there is it's called behavioral economics. It's kind of looking at our behavior to do with things going up and down in value. And if you can do it without feelings, you're doing really well. And that's very difficult.
I
Very
like the
difficult.
fact that you say most people are emotional and whimsical. And I was thinking,
Random,
gosh,
random, and
random and
random.
whimsical.
Yeah.
I was thinking, oh, but I quite like Marks and Spencers. I can never.
Yes. Oh, I mean, yes. And or people meet. So, I mean, often people say to me, because I'm an investor, oh, what about this or what about that? And I always sort of smile sweetly and ignore them. Now, if they come up as options with my financial criteria, fine. But it's like, it's not, all that sort of stuff about tips and hunches and, oh, I just have so I remember um, speaking to somebody in my last job, which was for a charity, and I was talking about what I was doing, and he says, oh, it must be, you must be good because of feminine intuition. And I was like, no, it's nothing to do with that. It's having a strategy and being ruthless. It's nothing.
Yes.
You don't want to be getting into any kind of intuition with the stock market because nobody knows what's going to happen. So, and if they do, they might not be telling the truth.
Right. Okay. Yeah. So that's less likely. All
Yeah.
right. So is there, so I'm going to trade, I'm going to have an ISA.
Are you going to trade or are you going to invest?
Oh, sorry. So sorry. I've got it all wrong already. Start
Yeah.
again. I'm going to invest. I'm going to
Yeah.
have an ISA. I'm going to start with a fund just to see how I feel about my fund going in. I'm only going to invest money that I don't want to lose, but I know that particularly that first investment, can I afford to lose this £10? I don't want to lose this £10, but could I? Yes. Put £10 in a fund. How did that feel? How can I get less emotional about it? Manage those emotions. I'll probably have a spreadsheet because I love a spreadsheet. And the fact that I haven't mentioned loving spreadsheets so far is quite unusual for me because that maybe it should be called the Wealthy Spreadsheet, the podcast.
Yeah. I like a good spreadsheet myself, I have to
Love a
say.
good spreadsheet.
Colours. Yeah.
Yes, colours. I get lost in the colours. Right. So I've got all of this. I'm not going to read company accounts. You're going to help me work out whether I need an online broker or a robo thing. And then there will be these ideas that are coming through. And I'm not going to be whimsical about it. I'm going to have this strategy. And you've mentioned about this strategy a lot. Is the strategy like I will talk to my property investors or potential clients about having a strategy? Just did one before I was speaking with you where I was saying to her, you start off and however much money you've got now, we'll buy you a few houses, and then as you get more money, we'll buy some more houses, and eventually you might get to 10 or 15 or 20, whatever your number is, and we'll work that out, and we'll get there and we'll go, right, okay, you've got enough houses, and now because you've not been using any of the income, we're going to start paying them down, and the strategy is to acquire them now while they're cheap, using mortgages to leverage it because we can, and then later on we'll pay them down so that they become completely unencumbered assets, which means that you would use the word dividend, but the rental profit that they kick off is much higher. And I know that in the future that I'm going to have 10 properties with no mortgages and a minimum of £700 a property coming in. So I know that in 10 years from now, if I bought one property every 10 years or whatever I did, I'd have a wage or an income to my family of £7,000 a month. And that's how I've done my strategy. How do we now what does that mean in terms of strategy for investing in shares?
Well, did you hear the ambulances?
Oh no, I didn't hear the ambulance.
Oh, sorry, it's fine.
Search for the ambulance. We've talked about the fact that she gets ambulances going past. So, and I completely missed the advert, so I have to go
Oh,
back and
okay.
listen to it.
So in terms of a strategy for investing, once you've started, which is fantastic, if you've like opened an account, put some money in and bought something with it, you're off. So that is great. Then the thing that people are working towards, which is the same for property, is working for this thing called like financial independence or freedom. So that means when you have investments, which could be in the stock market or property, which can give you an income that you can live off. So, and traditionally, so I think once you've started, then the strategy to get into is then be consistent about paying in at least 10%, investing at least 10% of your net income every month, just whatever. And if it doesn't have to be 10%, you can start with, £20 or £30. You can still start just to get you going. So to be consistent with that, to pay in more if you can. And then there's the choice about whether you want to do sort of, as I would call, simple investing in these things called funds, or whether you want to do more adventurous investing, which is investing in individual stocks and shares. You do need more capital for that, because if you're buying individual stocks and shares, there's a cost for every time you buy or sell. And so you want to, you don't want that to eat away at all your investment. So then it's chugging away, it's going away, you're not looking at it too often, you haven't got apps on your phone, so you're kind of getting panicky about it. And then in the long term, you're wanting to grow your pot to reach this amount, and it's different for everybody where you live off your income. So say you were aiming for, it's like looking at, okay, say you wanted to in your future you had something from a pension, you were still working for a little bit, and you wanted to create £1,000 a month from your investments, then you would need to grow your pot to that amount that it could give you that amount. And that depends. I mean, sometimes what people do is there's a way of investing, a traditional way of doing it, where as you get older, you put your investments more into these things called bonds, which are meant to be safer. You get a sort of certain rate of interest on them, and you live off that. Unfortunately, that rate of interest on bonds hasn't been that great that recently. Or what you might do is kind of sell off some of your investments and live off that cash. Anyway, it's a more kind of complicated thing. But that's what you're aiming for in the long term, is that you've got enough there, a bit like houses, that you can live off the investments.
Right.
That's the purpose in the long term. That's what you're going for. And of course, it's not the money in itself, it's what the money can give you, which is like freedom and time and to be generous and all that kind of business. So.
Yes. So how am I actually getting money? So I know with property, it's my rental income. The tenant pays the rent pays the mortgage and the letting agent and any repairs, and then I get what's left and it comes into my bank account.
Yeah.
My understanding of shares is that there's this thing called, I did a module at university on shares, but the university lecturer and I didn't get on because we'd clashed over our views on unions or something, and it just, I don't know, it wasn't one of my best modules. But I remember that there were these things called dividends that usually get paid out once a year. Do jargon busting dividends.
Okay, so dividends are, so when what companies do is they make profits, and then they will pay a certain amount of that to their shareholders in dividends. So if you buy an individual stocks and shares in an individual company, you receive some money from them generally every year in dividends. If you have a fund with lots of different stocks and shares, you'll get like a collective amount of dividends from them. So traditionally, when people get a bit older and they're nearing wanting to live off their investments, they'll shift their investments into more either into these kind of type of investments called bonds, which give them a rate of interest, or into companies that pay good dividends. So it's like an investing style.
Right.
Is that you're investing in things. So for at the moment, like I'm looking for companies that are going to grow in capital value, to get the most growth as possible. And then I receive some dividends. But later on, sometimes what people do is they have less things that are growing less but give them more dividends. So it's like a different way of investing.
Okay, so that's the same with property again, in that I could buy that house because I know that If I buy it and I do it up, then it's going to be worth more. So you're doing your capital growth,
Yeah.
or I could be buying it because I know I'm going to get great rental. So the rental is the dividend. So the other thing with the shares that I've just clocked, and I know this, I'm going, why haven't you had this all before? Probably because I've never had the time to have this conversation. So I thought it'd be great if we have this conversation on a podcast, because hopefully other people, whether you're male or female, you're interested in this, you'll get a bit more education out of it, and you'll go, yes for me now, yes for me in the future, or no, still not interested. That's absolutely fine. I could, whether I am buying single shares or a fund, put some money in. I might early on want to pick companies that are going to grow. So time machine back, buy Zoom, Zoom's going to grow. And there's a little bit of, I presume, because we're not whimsical or random, there's a little bit of information there that would tell me, I feel I know a word called emerging markets or something, so it's either something that's done well somewhere else that's now going to another country, or something like now the whole AI thing that we're getting more into AI. And then over here, I might invest in company A, B, and C, because I know that for every £100 that I invest, I don't know, I'm going to say £10 as a dividend. So for every £100, I'm going to get 30 quid back. So I could do the maths and go, well, I want 300 quid. Well, then put in £1,000. £1,000 will give me, I don't know what I've done. I've lost myself in my numbers because I didn't write them down then. But whatever it is, I could do the maths that said, if I want this much money coming out, I could put that much money in. And I can have a little bundle of shares there that did that for me, because I do want some of that coming in. And that might actually then pay for the fees that I can then. Is this a little bit more risky that my capital might grow, because actually my capital could go down instead of going up, isn't it? Would you have both sides?
Okay, so emerging markets, just to be clear, emerging markets. So the thing about investing is the idea, if you have a spread your risk and diversify, you'll have investments or funds in different parts of the globe. So, you have
Okay.
America, you have Europe. Emerging markets are places like China, Southeast Asia. So they're growing economies.
Yeah.
So if you've got if you've got, you want funds that cover all the bases, both in terms of parts of the globe and also actually what kind of business activities. So what some people do, I mean, some people they just have funds, and that's completely great. Some people have, they might invest some in funds, and then they might have a certain percentage of their portfolio in individual stocks and shares. Because the thing about individual stocks and shares, and I've experienced myself, is that they can be, my returns have been much better from that. And they are also much more, as they say, volatile. So they go up and down a lot more. And for some people, it's like you don't want to spending any sleepless nights over your investments.
Yeah.
It's just not worth it, that kind of thing. Or some people start with funds and then they think, okay, I'll do a few stocks and shares. Now, the things about dividends is that the thing is, we don't know. We don't know what dividends companies are going to pay. We just can't, because we don't know what's going on with the stock
Yeah.
market. But what you can do is you can buy funds that focus on investing in dividends, high dividend,
Okay.
dividend earning companies. That is like a way, as a way of investing. So it's just always good to have a
A
balance, and
balance.
yeah, have a balance, and to do what you feel you've got time and energy to do. So funds is pretty, reasonably straightforward to set up. Then you leave them alone for a year, and then you review them once a year. Individual stocks and shares, it depends on how you're investing. But yes, there are kind of resources where you can just see all the kind of financial information you need to know to choose ones that you think are going to do better. You don't know, but you have a better chance that they will do better over time. And the thing about investing in individual stocks and shares is if they are growing more quickly, it just gives a boost to your overall, it sort of gives it a little hoik up. It may only be one company,
Yeah.
just a bit of a boost to the kind of growth of everything as a whole.
But then if 1 year you're looking at your shares and they have decreased in value, so I bought £100 worth of shares and now they're only worth £90 or worse,
Yeah.
£50. Well, unless you have to sell them, don't sell them and keep them, and maybe they'll be worth more.
Well, people do that actually, and so this is what I was saying about being ruthless. So the thing that people always do is when things go down, they want to hold on to them till they do better. When they do well, people want to hold on to them because they think they're going to carry on better.
Do more better still.
Yeah, that's terrible English.
I know.
Better,
But this one was doing better because it was
yeah,
low and it's going to do better, and then this one is going to do
yeah.
even more better.
Yeah, but that it doesn't. What I found is it doesn't work that way. So this is the thing about being
Okay.
consistent. So if things go down, then say there was a share that came down 30% or something like that. It's highly unlikely. It's going to take a long time for that to come back up. So the thing is to sell it off. You might have
Right.
lost money, but it's better to sell it off in the way I invest and then invest in something better. But then there's also times when things are doing really well, but the numbers are coming back. And it's like, well, it's not going to do that well in the next 6 months, but it's like, oh, I really like this company. They make, I don't know, whatever it is.
Yes.
And so that's the same thing about it's not having any feelings. So
Yes.
it's the same thing. I call it clearing out the dead wood and sort of letting go of the fresh wood.
Yeah.
That's the consistency.
Yeah.
Yeah.
Okay. All right. I've got it. Yes. English and dodgy maths and everything else that's gone on in this podcast aside.
Yeah.
Much clearer. Thank you.
Good.
So look, we've run out of time because we've spoken so much about this. I haven't even got round to what it's like to be a woman in a man's environment. So I think you're definitely going to have to come back and we'll have a whole nother conversation about that. But I'd just like to start off by saying thank you very much for giving me your time.
My pleasure. It's been a pleasure talking to you, Vicky. Thank you.
I'm just always very conscious that, I've had a great time, but I am taking other people's time, and I'm also taking the listeners' time because I'm hoping that they're listening and getting value out of this. So look, if people are more interested in this, which I hope after this they are, that we've piqued their interest, how can they learn more about this? Have you got a website we can get to and everything else?
I've got a lovely website, even if I do so myself. So if you just look up Simple Successful Stocks, 2 C's, 2 S's. I'm not saying that to be patronising, but I have to remember how to spell it myself. And I've got a website. There's a complimentary guide you can download. Girls just want to have funds, the 7 simple steps to start investing. So that will give you all the information you need to start. It only takes 15 minutes to read. It hasn't got any charts in. It's got some nice pictures. So connect with me on LinkedIn or Instagram. And if you want to know more about working together, then I offer, a free conversation so we can have a chat about that more. So yeah, get in touch.
We'll make sure we stick all of that information in the show notes so that if people want to go along and look all of that up and learn how to spell simple, secret, whatever was S's and C's things there, it'll all be in the show notes. You'll be absolutely
okay,
sorted.
great. Thank you.
But to you, the listener, I hope that, this is the very first time that I've really had this conversation about investing in shares. And I hope that I've sort of like piqued your interest a bit here, that this might be something that you can do maybe alongside your property investing, or if you're not investing in property, this is something that you could be doing to actually get you going. I think there's a lot here, but I think what I'd also really like to pull out to you is, particularly if you're a woman, the values thing. Do you value your financial security? And if you're a man, I'm still going to ask you the same question. Do you value financial security? And I'm just guessing, but I think quite a lot of you are going to say yes. Whereas I don't know that a lot of the women listening will be saying yes as well. So I'd really like you to all start thinking about your financial security. And that's going to be the mantra for 2024 and the next, I don't know, like 50 odd podcasts that we'll do in this year is financial security, because that's the way to know that what comes is sorted. A bit like when we started right back at the beginning, and Elizabeth said you need to have £1,000 if your dishwasher blows up, and you need to have 6 to 9 months worth of wages in case we decide we're going to do another pandemic. Having those little anchors, financial anchors in your life, just takes away all that stress. And that's what we want. We want stress-free lives, because that's how we can live wealthy, happy lives. So I hope that I've been able to give you some whoosh. I hope that how can we play with Elizabeth? I hope that Elizabeth has been able to give you some whoosh as well. We've both whooshed you towards investing in shares and give you more information that way round. And so it just beholds me to say a very final thank you so much, Elizabeth. And what I'll do is get you back and we're going to talk more.
Great. Thank you, Vicky. That would be lovely. Thank you so much.
Thank you very much for listening, everybody. And I will see you again next week.